Investing is a way to grow your money for the future. Many people invest to reach goals like buying a house, saving for retirement, or simply having more financial security. One popular method of investing is called dividend investing. This strategy focuses on buying stocks that pay dividends, which are small payments companies make to their shareholders, usually from their profits. Dividends offer a special benefit. They provide a regular income. This can be especially helpful during times when the economy is not doing well, and other sources of income might be less reliable. In this way, dividends can help you feel more secure about your money. In our discussion, we will use insights from financial experts such as certified financial planners and qualified financial advisors. These professionals help people make smart choices about how to manage their money and grow their wealth. They understand the ins and outs of different investment strategies and can explain why dividend investing is a wise choice for many investors. In this video, we'll explore 5 main reasons why investing in stocks that pay dividends is a go-to strategy for persons looking to building wealth. We'll talk about how it can lead to a steady income, the advantages of reinvesting those earnings, tax benefits, how it can be used to hedge against inflation, and its potential for capital appreciation. By the end, you should have a good understanding of why dividend-paying stocks are a valuable addition to your investment portfolio. Number 1. Stability of income. One of the biggest benefits of dividend investing is that it offers a stable source of income. This means that people who own dividend-paying stocks receive regular payments that can help cover their living expenses, save for future goals, or reinvest to grow their wealth. Here's how it works. Companies that pay dividends send out a portion of their profits to their shareholders. These payments are typically made every 3 months, although the frequency can vary. The key point is that these payments are planned and regular, making them a reliable source of money. This reliability is particularly valuable during tough economic times. When jobs are scarce or salaries are not increasing, having a steady income from dividends can make a big difference. It provides financial breathing room and reduces stress about money. Experts like certified financial planners and qualified financial advisors often recommend dividend stocks for this reason. They know that these stocks can bring a dependable income, which is an essential part of managing your finances well. With regular dividends, you can plan your budget more confidently, knowing that you will have this income at set times throughout the year. Number 2. Reinvestment opportunities. Another great advantage of dividend investing is the opportunity to reinvest your dividends. This means using the money you receive from dividends to buy more shares of the company or other stocks. Reinvesting can significantly increase your wealth over time because it compounds. This is like making money on top of the money you've already earned. Imagine you own shares in a company that pays dividends. Instead of spending those dividend payments, you use them to buy more shares of the same company. Now, when the next dividend payment comes, you'll receive dividends not just on your original shares, but also on the new ones you bought. Over time, this cycle of buying more shares and receiving more dividends grows your investment faster. Using a simple example like the S&P 500 index fund can help explain this better. An index fund is a type of investment that includes many different stocks, reducing your risk. If this fund pays dividends, you can reinvest those dividends into more shares of the fund. This strategy is particularly safe and effective for long-term growth because the S&P 500 index fund includes large, stable companies. Certified financial planners often suggest reinvesting dividends as a smart way you can use in building wealth. It's like rolling a snowball down a hill. The longer it rolls, the bigger it gets. The same happens with your investments. The more you reinvest, the larger your potential future earnings become. Number 3. Tax advantages. Dividend investing not only provides a steady income and the opportunity to reinvest, but also offers tax benefits that can save you money. Dividends are treated differently in tax laws than other types of investment income, which can be a big advantage. When you receive dividends, they can be categorized as qualified or non-qualified. Qualified dividends are taxed at a lower rate compared to regular income, and non-qualified dividends, This means that you get to keep more of the money you make from these dividends because you pay less in taxes. For instance, let's say you're in a higher tax bracket, where you normally pay 25% on your income. Qualified dividends might only be taxed at 15%, significantly lowering your tax bill on this income. This lower tax rate helps your money to grow faster because you are not giving as much away to taxes. Certified financial planners and qualified financial advisors often emphasize the importance of understanding these tax benefits. They know that by choosing investments that offer qualified dividends, you can enhance your overall returns and keep more of your earnings. This is an essential part of effective wealth management. Overall, the tax advantages of dividend investing are a key factor in why many choose to include dividend-paying stocks in their portfolios. Number 4. Hedge against inflation. Inflation is when the prices of goods and services rise, decreasing the purchasing power of money. This means that over time, the money you have buys less than it did before. Investing in dividend-paying stocks can be a good way to protect yourself against inflation. Here's why dividend stocks can be a hedge against inflation. As prices rise, companies may raise the prices of their products or services. When they do this successfully, it can lead to higher profits. Companies that are making more money often increase the dividends they pay to their shareholders. So, if you own stocks that pay dividends, you might receive higher payments during times of inflation, which helps maintain your income's purchasing power. Additionally, dividend-paying stocks often belong to established, financially stable companies that can weather economic ups and downs better than newer companies. These companies can adjust to inflation by passing on higher costs to consumers without losing business. This ability to manage during inflationary times makes them solid investments. Certified financial planners and qualified financial advisors typically suggest including some dividend stocks in your investment portfolio as part of a broader strategy to manage inflation risk. By receiving regular dividend payments, investors can feel more secure knowing they have a source of income that could increase with inflation, helping to cover higher costs of living. Number 5. Potential for capital appreciation. Capital appreciation is when the value of an investment increases. This means that the stocks you buy could be worth more over time. Dividend-paying stocks offer not only regular income through dividends, but also the potential for capital appreciation, making them a dual-benefit investment. Here's how it works. When you invest in dividend-paying stocks, you're usually investing in established companies that have a consistent record of paying dividends. These companies are often industry leaders with solid business models and a history of steady growth. Over time, as these companies expand and generate more profit, their stock value can also increase. This increase in stock value means you could sell your shares for more than you paid, gaining a profit on top of the dividends you received. It's important to remember that stock prices can fluctuate due to various factors like market trends, economic conditions, and company performance. However, companies that consistently pay dividends are often seen as more reliable and less risky compared to companies that don't pay dividends. This perceived stability can make their stocks more attractive to investors, potentially driving up the share price. Certified financial planners and qualified financial advisors often highlight the importance of capital appreciation in building wealth. By combining the steady income from dividends with the potential for selling stocks at a higher price, dividend-paying stocks can significantly enhance your financial portfolio. Now, if you want to learn how to achieve financial success, then watch this video next. And if you made it to this point of the video, please like and subscribe to this channel to see more content like this. Thanks for watching, and I'll see you in the next video.